What is an accumulation trust for retirement accounts? Have you ever wondered how retirement accounts can be managed after someone passes away? An accumulation trust is one way to handle these assets. This type of trust is specifically designed for estate planning, allowing retirement account assets to be held in trust after the account owner's death. Instead of passing directly to beneficiaries, the assets go into the trust, giving the trustor control over how and when distributions occur. One of the main features of an accumulation trust is the control it provides over distributions. Unlike a conduit trust, which requires all required minimum distributions to be passed directly to beneficiaries, an accumulation trust allows the trustee to keep those distributions within the trust. This means the trustee can decide when and how much to distribute to the beneficiaries. This is especially helpful if the beneficiaries are minors, have special needs, or may not be financially responsible. Tax considerations are also important when it comes to accumulation trusts. The trust must comply with the Setting Every Community Up for Retirement Enhancement Act of 2020. This law states that inherited retirement account assets must be fully distributed within 10 years of the original account owner's death. At least 10% of the trust's share must be distributed each year. While required minimum distributions can be reinvested within the trust, any income generated from those reinvested funds is taxed at trust income tax rates, which are often higher than individual rates. This could lead to a larger tax bill if funds stay in the trust instead of being distributed to beneficiaries. To set up an accumulation trust for retirement accounts, certain legal requirements must be met. The trust needs to name specific beneficiaries and become irrevocable upon the account owner's death. The trust document must be provided to the retirement account custodian to ensure proper funding and administration. Accumulation trusts are often used to protect retirement assets for beneficiaries who may not be ready to manage large sums or to delay distributions for tax planning or creditor protection. The trustee's discretion helps ensure that funds are used wisely over time rather than being given outright, which could lead to mismanagement. When comparing accumulation trusts to other types of trusts, the key difference is how distributions are handled. In a conduit trust, all distributions from the retirement account go directly to beneficiaries. In contrast, accumulation trusts allow funds to accumulate within the trust, which can be beneficial for asset protection but may result in higher taxes due to trust income tax brackets. In summary, an accumulation trust for retirement accounts is a useful tool in estate planning. It allows for the management of retirement assets within a trust framework, balancing control over distributions, tax implications, and protection for beneficiaries. This approach is particularly relevant in the context of estate settlement and distribution of retirement accounts held in trust, ensuring compliance with current laws while addressing the unique needs of beneficiaries.